Hello everyone, I'm Edwin. I'm so happy to see you here again. The most asked questions by students is definitely how to kickstart their investment. So in other words, what type of strategy should they use for their investment? There are two main types of investment philosophies. The first one is passive investment. This type of investment philosophy believes that individual investor is unable to beat the market and is not worth to devote time and effort in putting our attention on the stock market from day to night. So therefore, passive investment suggests investors to invest in a basket of stock to reduce risk with diversification benefits. As stock market is on its uptrend in long run, passive strategy can provide pretty good return to risk trade-off. A buy and hold strategy can be on a basket of stock in the same market, same industry, or with the same theme. For example, my favorite one is buy and hold S&P 500 ETF. There is also a growing interest on ESG related funds. The second philosophy is active investment, which is much more commonly used than passive investment. There are different kinds of active strategies. Active investors believe that they have the ability to get return better than the market. It means beat the market. I like to classify investment strategies into three main categories. So the first category is to believe in yourself. The rationale is that due to the market sentiment, stock price can be deviated from fundamental value in short term. Therefore, we can pick up those underpriced stocks to make a profit when they go back to the fundamental value. Fundamental analysis stress on focusing on company's financial ratio and the way to estimate future growth. Another type focusing on investing in the stock that you understand, such as we can invest in a company that delivers high quality services and products. The second category is to believe in the market. The rationale is that market repeats itself and has its repetitive patterns over time. So we can actually pinpoint the pattern, then we know when to buy and sell, so making pretty good profit. Technical analysis is the most commonly used for people exploring repetitive pattern in the market, like candlestick, RSI, moving average, or Bollinger Band. A more sophisticated one is the quantitative investment strategies by using artificial intelligence and big data. The third category is to believe in others, such as getting inside information from your friend, online forums, stock experts showing up on TV, and KOL on YouTube. Before looking for your suitable investment strategy, I would like to talk about the basic in selecting investment strategy. The average return of the stock market is approximately the return of the market index. So investing in the stock market is not a zero-sum game. Investors can make profit together. As long as the economy keeps growing over time, investors should all benefit from getting more money. But for those who want to beat the market, that is to earn abnormal returns over the benchmark, they are actually competing in a zero-sum game. If someone outperforms the market, it means that someone underperformed the market. Like if you buy an undervalued stock from others, then others must sell this stock to you too early and make a mistake. So your profit is actually his losses. Moreover, given that there is brokerage fees, taxes, and the bid and ask spread, is actually more likely to be a negative sum game. Therefore, this probability of being a winner in beating the market is not 50-50. Many studies have shown that investors generally underperform the market. So, as long as you invest in the market index fund, actually you already outperform most of your peers. So of course, there are quite a lot of investors can beat the market in the short term, especially during the bull market, like in 2007, 2015. We always got some, for example, got of stock picking in university. But then when we wait for long time horizons, we find that it's very hard for a guy to consistently beat the market, except Warren Buffett, I guess. So if you're really interested in making your own stock pick, I would say that yes, it is still a chance. There's, I guess, 1% of trader can actually outperform the market. Then in this case, if you really want to spend time on evaluating and investigate stock investment, we should actually focus on fighting the battlefield that we have an edge over others. Then you stand a chance to beat others, and then at the end earn abnormal returns. So what are the advantages of individual investor? Let's go through different active investment to discuss it further. The first type of active investment is fundamental analysis, which is mostly recommended by professional investors Warren Buffett, Catherine Wood, using fundamental analysis in managing their funds. This analysis includes analyzing companies' management culture, recent development, and competitiveness in the market. Also using different financial ratio to compare with their peers in the industry. So therefore, according to their estimate, to find out the fair value of the company using some discount model. And the final step is to list out all the potential risks on investing in this company and make final conclusion. Fundamental analysis is the most commonly used for professional investor and fund managers. So is it good for individual investor as well? I only give rating of 3 stars. So I just said that it's used by many professional investors, but why don't I recommend to individual investor? First, fundamental analysis requires investors to have a deep understanding on financial statement and the industry. It's not an easy task for individual investor to beat professional investor in this battlefield. Second, some studies found that even for mutual funds, their average return is worse than market index fund. So it seems that even having professional knowledge, superior teams, and information, professionals still find it hard to beat the market. So that's why I'm not that recommend fundamental analysis to retail investor. The second method is advocated by Peter Lynch that individual investors should focus on invest on what they know. That is, we should focus on our life experience in picking up good companies. So like when you find the quality of a shop is good and your friend like it as well, you may consider to buy the stock of the company that provides the goods and services. For example, if you need to meet people online after the start of the pandemic, you may consider to buy Zoom. Let's say if you like yoga and you find that your friends also like yoga more and more several years ago, then maybe you should actually buy Lululemon at that time. Or if you are fascinated on PS5 but cannot get it, then you may know that maybe there's a shortage in PS5 and it implies that the demand is very strong. Then if you want to buy PS5, why don't buy Sony together? I give this trading strategy 4 stars. I pretty agree with Peter Lynch that our advantage over professional investor is our life experience on consuming products that we use and share from our friends. So of course, it's not an easy task when it comes to real investment. So let me share more about how to use it in another video. The third method is the technical analysis that is mostly used by individual investors, like using candlestick, RSI, moving average, and MACD to try to predict stock price movement. Its rationale is that there are certain repetitive patterns in the stock market. As long as we can find them out, we can make profit from them. Unfortunately, many studies have examined different types of technical analysis and found that they cannot help us to improve our returns. Instead, it needs to more transaction costs due to frequent transaction. So I only give 3 stars. Then why I still give 3 stars to it? Using technical analysis solely in trading will make us to fall in the trap of frequent trading, but as a supplement indicator is quite helpful. We can learn how market views the particular stock. Then we can estimate how far our expectation is from the market expectation. Then we can think again whether we are overconfident on our view. And I guess 99.9% of investors would use historical charts as a reference in making their investment decision, even for fundamental analysis, because you can know what happened for this stock in the past. Let me share more about my experience in using technical analysis in other video. The fourth one is quantitative investment. Traditional investment strategies focuses on learning investment principle and understanding key factors that can help to predict stock price movement. Then we use the knowledge in the current market to find out good investment opportunities. Quantitative investment is in the exact opposite way. It's connected with big data and machine learning. So based on historical data, the black box will help us to find out the factors that affect the stock price. So the computer will then formulate a strategies and trade using the black box to make money. My rating for this strategy is only 1 star. You may wonder why I give the rating so low. Isn't big data and machine learning help us a lot in our life? Yes, they are very useful in our life, but there are some problems for individual investor to use quantitative methods in investment. First, quantitative investment relies on the assumption that historical trend can predict the future. But the problem is that when a lot of experts and professionals are working on quantitative investment, their trading strategies would also change in as to capture the opportunity. So the trend of making money in the past can gradually become non-profitable. Research shows that actually many strategies that are useful in the past is not that useful right now. We also find that the average return of hedge fund using quantitative trading has been falling. In recent years, their returns are actually less than the S&P 500 index returns. Second, even quantitative investment can increase investor returns. Individual investors are at a disadvantage when competing it in with other professionals. Many investment banks and hedge funds invest billions of dollars in buying data, hardware, and recruiting talents. So it's very hard for individual investors to beat the market with this strategy. The fifth method is to listen to others' recommendation. It can be a recommendation from your friends, an online forum, an expert on TV, or online YouTubers like XX Stockmaster or those XX admin, somebody like that. My recommendation for that is only 2 stars. First, in the short term, there are people who make big money by this method, but in the long term, we find that it's very hard for us to find someone that they just hear from others and can make money in the long term. Second, there are many traps like pump and dump strategies, and it's hard for us to distinguish whether it's really a dump and pump or an inside information before it happened. So we know that, of course, there are some experts are very good. So in case if you really want to use this method, I would suggest you to use some paper trade to mark down their recommendation and see what happened for following their strategy for 3 to 6 months. If their advice are that great, even you may forgo 6 month chances to make money with their strategies, you can still rely on it to make pretty good profits in the long run, right? But in case those recommendations are not that helpful, this method can actually help you to save a lot of money in losing from trading. The last type is passive investment. For example, my most recommended long-term buy and hold strategies on S&P 500 ETF. We can see that in the past 40 years, although there have been up and down, there's a clear uptrend. And S&P 500 indirectly holding 500 companies at the same time, and through diversification, investors can greatly reduce their risk. We know that even for Yahoo, Kodak, Nokia used to be giant in the market, they can still drop to almost zero or drop more than 90% from its highness when things go south. So that's why using a portfolio is actually better than investing in one or some individual stock. Moreover, buy and hold strategies can reduce our psychological pressure on finding the right timing for buy and right timing to sell. And we do not need to be afraid of stock drops after buying and stock rise after selling it. So I certainly will give 5 stars for passive investment. So of course, today's video is just a simple introduction to the pros and cons of various investment strategies. Although I'm a passive investment fan, I still have a small amount of money used for active trading. Later, if I have time, I want to share more with you. I hope today's videos can make you to think about which investment method really suits you. I'm Edwin. Thank you for watching today, and then hoping forward to see you again next time.